Hey guys, Adam Karch here, Karch Lending Team. I get asked a lot, and I love this, by the way. I love the fact that I get asked this question a lot because it means that you guys are starting to plan, thinking ahead a little bit, and I like that. But I get asked a lot, okay, so hey, Adam, I'm thinking about buying a house next year. What do I need to be doing to get my stuff in line, my finances in line, to be able to be in a good position to get the best loan possible? And it's a great question to ask. So what I want to do is just kind of go over quick the fundamentals of getting a mortgage loan. And when you have these solid fundamentals, you're going to get the best scenario possible. So there's three main things. One is your credit score. Two is your loan to value. And three is what's called your debt to income. So those three things really make up a good solid foundation for getting the best mortgage possible. So let's go over them. The credit score. Credit scores can be a pretty wide range. In order to get a good solid mortgage, I've seen kind of the teetering point being that 680 mark. We can do loans all the way down into the 500s, which is kind of crazy as far as the credit goes. But you're going to start to see anything I've found, anything under that 680 mark is going to start to be a little bit more disadvantageous, so not very advantageous. Type of terms as far as the rates and the private mortgage insurance and things like that, depending on the down payment. So really work towards getting that credit score. I'd say above that 680, anything over 750 starts to be kind of the A credit tier, 760, 780. There's a couple of different tiers depending on the lender and things like that. But really that 680 I've found to be kind of the tipping point on where you want to be for sure. Get into that sevens, get into the eights if you can. But there's a ton of resources out there for tips. I hope to do some videos here in the future as well on how to get that credit in line. And you can always reach out to me and ask, and we can go over the things that make up the credit score and kind of talk about that as well. Number two is your loan to value. So what that means is ultimately what you have for a down payment. So if the value of the house is $100,000, let's say, and you want to put 20% down, you're going to put $20,000 down. Your loan amount is going to be at $80,000. So your loan to value, $80,000 versus $100,000. That means you're at an 80% loan to value. You don't have to have 20% down. You do not have to. It does put you in kind of the best scenario because it eliminates what's called private mortgage insurance. But you can do a loan really as little as no money down, depending on the scenario. And then anybody can do it with as little as 3% down. Again, you're going to, as you start to get a better loan to value position, closer to that 80%, over that 80% loan to value, or under that 80% loan to value, you're going to continue to get better tiers as you go at 3, 5, 10, 15% down. So that's the other thing that you really want to be thinking of in starting to build savings for that down payment to get you into the best loan to value position possible. And again, that's a strategy that we can talk about and what to look for going into the future. And then the third main pillar, the third main fundamental of getting a mortgage loan is what's called your debt to income. So your debt to income is really just that, your total monthly obligations, so your monthly loan payments for things like car loans, personal loans, credit cards, boat loans, RV loans, four-wheeler loans, all that kind of stuff. You know, the things that are on your credit as a loan. And then it also includes the potential principal and interest payment on the mortgage, as well as the monthly taxes and the monthly insurance on your new mortgage as you're going to be looking into buying a house. So all of that added together on a monthly basis versus your monthly gross income. If you're a W-2 borrower, self-employed starts to get a little bit different as far as our income calculations. But again, that's something we go into more depth on a specific basis. But if that number is your total monthly debts, monthly obligations divided by your total gross monthly income. And we want that number really to get approved for a loan. You got to be kind of, it's not a set in stone, but 45% is really the number that I always look for, just because that seems to be pretty across the board on what does get approved. 43, 45%. Under that number is what seems to be the kind of the sweet spot for getting approved for a home loan. So those are the three main pillars. I hope that information helps you or helps somebody. This isn't just for first-time home buyers. So somebody that is buying a second home, maybe they didn't plan very well on their first home and they want to plan a little bit ahead of time. This is the type of information that you want to start to be thinking about and start to be getting prepared for when you want to make that either that first move or that next move. Got any questions? Reach out, message me, email me, text me, whatever works. You can visit my website. You'll have all my contact information there, and we'll make sure we get some links in the notes here. And let me know if you got any questions. Hope this helps. Take care. Have a great day.